Hello, we are talking creative financing. I'm Alan Corey, Real Estate Maxi with
Tom Brickman, the Frugal Gay.
And Lauren from Adulting is Easy.
And if you've got comments, you can go to either our Facebook pages or YouTube pages, or
I don't have
Tom,
YouTube.
Your LinkedIn page, and leave comments. And we'll happily, try to answer your questions. But we're talking seller financing today, and we all have seller financing stories, and why seller financing matters. Well, a lot of times it's the only way you can get into the game and get started.
I want to tell a story that I just negotiated this week for seller financing. So I've been working on this deal for a while, and it has been sitting for about 2 years. And they had a terrible eviction process through COVID and just don't want to be landlords anymore. Needs significant work. The bank's like, we're not going to loan anything on it till you fix it. Okay, no problem. So I went back to them and I'm like, can we do 10,000 down and you owner finance me? I spend the rest of my money fixing it, and then I get a loan on the back end. So you finance me for, I said 12 to 18 months in the original offer. After some back and forth, they finally came back. They're like, we want 6,500 down. I'm like, oh, you want less? But it actually protects them. And I'll explain that here in a second, because I learned that the hard way. When you have less than 20% equity in the purchase price, the eviction process is much easier. And if I stop paying, they wanted to be able to get me out quickly, which I didn't do on one of my owner finance deals. So I'm having to go through a full-fledged 10-month eviction.
So real quick, is it an eviction or is it a foreclosure?
Foreclosure. I'm sorry, a foreclosure. I'm going through a foreclosure. They would just have to do an eviction with my less than 20% down. So we're doing 6,500. I've got a great 3-bedroom, 2-bath. $1,200 a month is what it'll rent for once I've fixed it. I have $35,000 earmarked to fix it, and I have access to the asset for $6,500. So that was a victory in my opinion. And we're also at 6% interest, which I think yesterday, most banks are quoting around 7 and 8 right now. So I'm in below interest rates. I've got 12 to 18 months to fix it, and then I have to pay them off. And then if it becomes too much, I can also sell it and just pay off the note that they've written on it. The attorney's written on it. So I'm $6,500, and that gives me more money to spend on the repairs. That gives me more money to really fix it up and make it look sharp. And that was a victory in my opinion. I've sold to tenants this way many times as well, but that one just went down this week, and I'm excited about that off-market property.
What was the purchase price of that?
So I'm going to be at 35,000 purchase, 35,000 renovation. So $70,000 total.
And you put 6,500 in. Yeah.
Yes.
That's what I love. And it's a cheaper rate. And how people listening, how do you find seller finance deals? How do you recommend that?
The people listening or me? Or Lauren?
Lauren?
Yeah. I mean, we both
that's what people are screaming. Like, this is great, Tom, but how can they do this?
Right? Lauren and I both have seller financing deals. I mean, wholesalers can bring them to you. Lauren's was friends of a neighbor, wasn't it? So the one that I purchased that I'm closing on was from a business card from 2019. So I've had a lot of those where cold callers, wholesalers can bring you stuff. Friends and family can bring you stuff. My best deal ever that I made $200,000 in equity was from a business card out at a flea market, and the guy who sold me nail polish inherited his mother-in-law's house. He didn't want it. It was hoarded. So he got rid of an issue. I got nail polish and a house. So it was one of those. So telling people what you do. People will send me things through DM. I don't know if you guys are getting them through your DMs, but people are like, I don't want this house. Do you want it?
Yeah, no, that's true. Lauren, you got into a multifamily through seller financing.
Yeah. So I looked at a 6-unit apartment building with my husband and originally my parents. I've never done a real estate deal with my parents, but my mom loves real estate. And so she finally sort of convinced my dad to buy this place because it was turnkey 6-unit apartment building owned by a contractor. It's probably the only way that you could get my dad into something if it didn't need any work. So we were looking at it. I originally made a deal like with my parents that we're going to do it, went under contract with them, and then like towards the end of the inspection period, I couldn't come to terms with my parents, which was a little bit awkward. So we fell out of inspection. 6 months later, I had put a new roof on a duplex that I owned outright, tented it for termites, got the other tenant paying post COVID. So made some changes to the duplex to make it more appealing, and was then like, okay, I can sell this if I do a 1030 exchange. That 6-unit was still on the market. I couldn't believe it. And so we agreed to a deal with him. We did full price. I think that probably helps a lot if you're going to get seller financing, but we agreed on sort of the terms before I even asked for seller financing. And that might be a best practice. I'm not sure, but we were basically like, okay, we're good with this price. Are you good with this much down, whatever. Well, hey, will you seller finance it? And they had, like Tom has done, this partnership had a couple other times where they had done seller financing. And because it had been sitting for so long, like they were willing to do it. They're willing to do the contingent sale of the duplex and do everything we needed to do with the 1031 exchange. And the interest rate, this was all throughout 2021. But the interest rates at the time were low for, typical residential, still in the threes basically. And the interest rate on that was a five-year interest rate with a 5-year rate adjustment and then a 7-year balloon. And at the time, 5% seemed really high. So we closed in December 2021 on that. And so something that's different with that is like my insurance and taxes, none of that's like escrowed or anything. So those get paid in big chunks, one big chunk in November, one big chunk in December. And then we just pay him just the mortgage for that. And actually we bought a lot down the street as well to help with parking. So we just pay him the mortgages for those, and it's $3,000 a month, and they go automatically. And then he literally emails me a statement, and I send it to my accountant every month. And so that's been really interesting. And something that was weird about it too, I thought, was he's like in his 80s and he's like committed to basically seller financing us for 7 years. So
that's great. I got into it a similar way. A guy couldn't sell his property. He actually had a portfolio of 30 homes, and he wanted to sell all 30 at the same time. They were in rough shape, and there weren't banks that would lend on it at the time. This was pre-COVID though. And so he had to try to sell it for eight months, and reached out and said, listen, I'll buy it, but I need seller financing because no one can get financing. From there, we started just working out a deal, and we worked out 10% down. And this was a $1 million portfolio. So 10% down, we only had to put $100,000 in, and we got 15-year note, my partner and I, 15-year note at 7% interest rate. And at the time, 7% was high, but even with a 15-year note, which just makes your payments higher, and 7% and 10% down, it was still cash flowing and crazy cash flowing. And
Right.
so it just made sense. It was great. And we would not have bought it otherwise, but that guy couldn't have sold it otherwise. And that's usually where seller financing deals come
Would
from.
it have been worth more if he sold each house individually? Like, do you get like a discount kind of for that too?
He possibly, but he didn't want to do that.
Sure.
But if he sells it all at once, then he can 1031 it as well.
Right.
But if you sell them one at a time, it's going to be really difficult to 1031. But it was one of those things where a lot of them were in rough shape. So if he sold, he could sell the winners, but then he would have a hard time selling the losers
Right.
without putting money into it. But if he lumped them together, like, yeah, you can have these winners, but you got to take all this other stuff with it. And they even threw in like 2 or 3 empty lots in the deal. They're like, I was like, I don't want them. They're like, you can have them for free. I'm like, all right, and I was like, okay. And so I ended up selling one of those lots for $5,000, and I donated 2 back to the city. But it was yeah, financing's out there. You just have to ask and say, is this possible? But it's always going to come from that seller who has had trouble selling their property.
Did they do with your guys' seller financing? Did they do a lot of due diligence on you guys? Because the guy for us did like none at all.
I had to turn in my last tax return. That was it. And he was just like, okay, this guy knows what he's doing, thankfully. But it doesn't show up on my personal credit score
No.
or on my DTI or anything like that.
Right. My guy,
Yeah.
I don't think he did anything. I don't. Maybe he Googled us and we didn't know. But
I did a credit report for one time, like they asked, and I'm like, here you go. And but yeah, it's usually very little. And I try and work hard to sell myself when I'm talking to them. Like I'm like, this is what I've done, this is what I own, this, to kind of give them some reassurance that you're not blindly selling me something and I'm going to ghost you the minute that we close and you're going to have to do a foreclosure or an eviction. But yeah, it's really how you sell yourself. So I've offered it up before when they've been hesitant, like here's my track record, here's this, let's do this. And usually it works out.
yeah, Henry, if I were the seller, I would want all of those things. I was a little surprised, and like he sold to an LLC.
So real quick,
Okay.
let's read his question.
Oh, sorry.
Go for it. All right.
Okay. Henry said, I was just about to ask how much the seller wants to know about you, income level, credit score, etc. And I would want to know those things. I mean, in with a 6-unit building, or really probably anything, we were putting it in an LLC too. So it's not like there was much background on the LLC. We had to do that because that's what we own the duplex in, because we were doing a 1031 exchange. And maybe we should go over what that is too. But I was kind of surprised they didn't ask for much. And I don't know, I was going to ask Tom, when you've done seller financing deals, you've done it to tenants. So maybe you already kind of knew their background, knew that they were good at making payments and things like that.
Yeah, the majority had lived with me for a year or two. So we had already done credit check and that through their already knew employment history. I'll recheck it to make sure they're still employed. And I've done it 4 times. It's worked out 2 of the times, and 2 of the times it has not, where they stopped paying in the middle. So it's a 50-50 for me right now. And it really depends on, on all 4, they took care of the property. Correct. I mean, they generally, and you can tell, if they care about a property or not. And sometimes it works, and then sometimes it doesn't work, and it's expensive to get your money back out, and timely and costly, because now I haven't collected anything for that property for it'll be 10 months by the time we're done with the foreclosure.
Yeah, and Henry on YouTube comments again. So it just varies from seller to seller, pretty much. Got it. That's completely true. I had another seller financing story where a guy did 100% financing. He had 2 properties. They needed some work, and he didn't want to put money into working it. And the way he actually did it is he donated those properties to his IRA, and then he did seller financing to me for 100% seller financing. And I had to make mortgage payments, quote unquote, to his IRA. And so that's sort of how you got paid back. So you can get really creative on the seller side, just as you can get creative on the buyer side to make this work for you.
Duplex that I did the 1031 exchange on, they bought it in their IRA.
Okay.
Duplex.
Yeah.
So it was like, if you think about that deal, duplex we owned outright, we sold it to somebody's IRA. We did a 1031 exchange into a 6-unit apartment building with seller financing. Lots of interesting elements to that one.
So many different ways to do it. I mean, okay, we're right now just on seller financing. What are other creative ways that we could finance a deal beyond seller financing? You guys want to go?
Yeah, I mean, I like the idea of lease to own. I was wondering, Tom, with yours, if that was anything anybody considered. I mean, I guess they were leasing and then they bought it from you, but a lease to own's a little different.
Yeah, and a lot. Alan, you want to share?
Well, I'll say this. I don't think that lease to own is advantageous to the buyer. Typically, it's very advantageous to the seller. And just get folks up to speed. Basically, it's saying, I'm going to buy your property in 2 years. Some 2 years, 3 years, some point in the future. Let's agree on the price now. And rather than me renting and try to get my credit right and do all this, I'm going to lock in a price. I want to give you a down payment right now. it's all negotiable, 5% down, 10% down. And then my rent payments going forward are going to go towards that purchase price. So if I make $1,000 a month for 3 years, the $36,000 is off that purchase price. And then we close on the deal. Now, why this is good for the seller is most people, by the time that day comes to fruition, they don't have their credit score correctly, or they've lost their job, or they decided they don't want to buy the house anymore. And so they've just been paying rent for 3 years and they forfeited that down payment. But I can totally see it if you actually follow through on the buyer side and say, this is going to be financed through seller financing or some other, like work on your credit score over those 3 months. Make sure that when that day comes, you can actually get a mortgage in your name. Then you could lock in a price that didn't appreciate for 3 years because you locked it. It could go either way. It could be lower than what you agreed to, but it could also be higher. So that's sort of how it works.
Yeah, I wonder what percent of those go through.
I think it's low.
I think
And
it's low.
and yeah, I think it's a low, and I have not done that. I want to agree to the price now and then see where it's at in 2 years, especially in Dallas, because they move quite a bit. So it's something that I just haven't explored, but I have had tenants when they're renewing leases, hey, would you sell it? What is this? And that's when we usually move over into a land contract or something like that, if it makes sense. And that's the other thing, is just being strategic with your portfolio, because there are times like I have a property I've owned for 20 years and it's getting close to time to sell that one off. And it's all part of a bigger picture of, okay, this is a duplex with 2 doors. What can I do to turn these 2 doors into 6 units or so on?
Have you sold to tenants like a traditional way, Tom, where they like, I want to buy it, and then they are able to get financing not through you?
Yes and no. So like one of them that I did, I just financed him actually just for 9 months, and then he was able to clean up his score enough. That was never the original plan, but he actually bought it outright in 9 months.
All right, we've got a question here from Lauren Bolin from YouTube. Real estate noob here. Is there any hope for finding rentals in high cost of living areas where literally no properties hit the 1% rule? 1%, and you need lots of capital. So the 1% rule is if it rents for 1% of the purchase price, which usually makes for a very good deal. Obviously, it doesn't occur in high cost of living areas. Lauren, how do you answer this?
Hey, Lauren, I know you from Twitter. So it's okay if properties don't meet the 1% rule. If you think of real estate, there's sort of this spectrum, right? Where stuff that cash flows a lot or stuff appreciates a lot. I kind of try to go somewhere in the middle, and you can game the system a little bit if you do short-term rentals like I do, where you kind of get appreciation and cash flow at the same time. Of course, it's more work. So if you're going to buy in a high cost of living area, we have our good friend Clint, right? He buys a lot of places in Vancouver, and they're not cash flowing. They're nowhere near the 1% rule. It's probably the 0% rule. Like he's maybe breaking even, but he lives and dies off of that appreciation, and it appreciates like crazy. So what he does is he buys a condo before it's even built, waits a year, it gets built, it's appreciated 10% by then, and then he does a cash out refi right when he buys, and then buys another one with that equity over and over and over. So you can do that. It's just, it's sort of like, do you want an appreciation play only? I like cash flow. I want to retire early. I want to use the cash flow to retire early from my job. So I'm not just going to bet on appreciation. I think Clint, at some point, Tom, maybe you've talked to him about this. I think him specifically, he's going to have to make a transition to cash flow at some point.
And yes, I have talked to him about that. And that's why I'm in both markets. Like I bought a Dallas property back in the beginning of February. My cash flow is going to be about $200 to $300 after everything's paid every month. And that's okay, because I know that where that property's going and where that neighborhood's going. And that's why I bought that property. And then, they're like, why would you put 80,000, 40,000 in, 40,000 down on this Dallas property when you could buy a $70,000 property in Toledo that cash flows $700? I don't have the appreciation there. So strategically, I can say that I did that on purpose, but really I started in college in Toledo. I bought one while I was there. I moved to Dallas. I saw that Toledo and Dallas were the same prices at the time. This is back 2009 when everything had dropped. And then I went back to Toledo after 6 or 7 years of buying in Dallas when I got priced out, because I could still pick up a single family 3-bedroom house for $30,000 to $50,000 there. and
Mind-boggling.
make money on it. And I couldn't do that in Toledo. So that was my real strategy there. And then
Mhm.
Lauren, also there are some non-traditional, like I had a friend who has $1 million rental in a high cost of living area. And it on the really even Airbnb it doesn't make sense. But what he's doing is renting it by the room. And he actually is cash flow plus on $1 million property because he's broken up, and he even, like, I think he has a sunroom that he rents. Like it's pretty crazy how he's sectioned up this house and made it make sense. So that's another way. And even in Los Angeles, and I mean it's crazy cost of living there, but he bought a large condo and turned the den into a second bedroom. So he's staying in the den, not a formal bedroom per code, but he's staying in the den. He's renting out the master bedroom, and it's covering over half of his mortgage. So that's the other thing that I've had people do is, yes, they're not cash flow positive, but they're house hacking it and they're making it work in different ways than traditional, Airbnb long-term rental.
Mhm.
I got my start in New York City, and so that's one of the very high costs of living, and I had to do it through house hacking. Bought a duplex where I lived in one unit, and then even within my unit, I got roommates. So that's really sort of, you're going to make some sacrifices in the high cost of living area. If your life does not align with that at the moment, then you have really no choice but to invest long distance. And it's really easy to do. Actually, I was looking at data yesterday. There's 11 states in the United States where the average home price last year was $209,000 and below. So like that's 11 states, a lot of Midwest and Southern states. And that's the average. And so you can buy houses for 50,000, 70,000, just as much as you can 500 there. There's a few million that skew that data. So I'd say all the time that there's $100,000 houses out there because I invest in them. Tom invested in them. Lauren's bought a few, and you just have never looked for it because you don't see it in your town. But I promise you, they're out there, and they're great money makers. But yeah, like back to Lauren's point, you have to choose one or the other. Do you want appreciation or do you want cash flow? It's really hard to marry the two. Of course, we always want to do two. And the difference being is if you're buying in a smaller, lower price point, it's going to cash flow better. But let's say you buy it for 100, it'll probably always be $100,000 house. But if you buy something in the city that's not cash flowing very much, well, then you could turn that $500,000 property into an $800,000 property. That's appreciation. And to me, that's very speculative, and that's not good foundation for real estate investing, especially if you consider yourself a real estate noob. I would say that's not the route I would go.
Mhm.
We've got financial fighter commenting, equity comes and equity goes, but the cash flow will always flow. And I think that's a
That
fair.
should be on a t-shirt. That's a good one.
Yeah. Raymond might buy that t-shirt. He says, OMG, what a killer crew.
Thank you, Raymond.
Right. Thank you.
But we got Henry asking us,
FHA.
yeah, plenty of financing options to choose from. In my early 20s, he's looking to pick up his first fourplex this year. I've been debating to go FHA route thus far. Any pointers?
I can't talk on this because I'm not a FHA fan. So typically when I talk to people, I'm trying to go like my duplex, I had to put 10% down. But Lauren or Alan, if you guys have experience or positives with FHA, you guys go.
I haven't done an FHA. It's fantastic because, like, if you're going fourplex specifically, if you end up with going conventional with a fourplex, even if you're moving in, they might let you put 15% down. So the FHA, it's 3.5%, regardless if it's 1, 2, 3, or 4 units. So that's the positive there. And it used to be, I don't know if this is the case anymore. It used to be when you got up to 20% equity, let's say you put 3.5% down, you got up to 20%. It's not called PMI, it's called MIP, whatever. The mortgage insurance premium, it used to fall off. Now I don't think it does anymore, which is really kind of a bummer because it used to fall off like traditional, like conventionals do. So there's also extra inspections with FHA, and they're real nasty about peeling paint, for example, which all my houses are old as dirt, so that doesn't really work for me. So but if you can find it, and this might be a good time to be an FHA buyer, because if I'm a seller, actually this happened to me. I was selling my very first house I had 2 offers the same day. This thing was listed for like 3 months. 2 offers same day, of course, same price, 225. One of them was FHA, 3.5% down. One of them was conventional, 20%. I took the conventional 20%. I'm just going to do that. I don't have to go through this extra inspection. And that's just more solid financing. The FHAs now, though, with it being more of a buyer's market than a seller's market, you may be able to get those through. I've been buying furniture because I'm furnishing another place, and I was somewhere and the house was for sale, and I'm like, so how you doing? And they're like, we're only getting FHA offers, and they also want us to pay for all of their closing costs. And so you get kind of FHAs get a little bit of a bad rap in a competitive market when there's a lot of buyers, but that may work now. And if that's all you've got, if that's your only opportunity, I'm going to tell you to buy the small multis all day, every day. Do whatever you can to get in a 2, 3, or 4.
I mean, I love FHAs all day, 3.5% down. If you live in a high cost of living city, you can, like in Hawaii, for instance, you can get a fourplex with a $2 million loan with FHA, up to $2 million. And that is just insane with 3.5% down, which is what, $75,000, $80,000. And you're buying a $2 million asset and you rent out the 3 other units. That's just going to pay that down. It's government trying to make you a millionaire. You just have to wait. So I love FHA all day. I think the loan terms are definitely a little bit more advantageous at 5% with the conventional down, but not everyone has that extra 1.5%. And you can pair some FHA loans with grants to help you with the down payment. So that also is a good combo to have as well.
Yeah. And there's it's like a number 203 or something. There's the Reno loan that you can get with the FHAs as well. And I don't know, that sounds, 203K. That sounds complicated, but man, if you could knock that out of the park, get an FHA loan, get the renovation loan, and then, house hack, and just, that's a cheat code to be a millionaire, like you said, Alan.
You know what I've been looking at? I'm in a historic district in Ohio where my short-term rental is, and they have grants going around for facade upgrade grants because you can't put siding up, you can't put certain windows in, and that's another thing of buying in that neighborhood. I don't know that this would ever be a great straight rental, but as a short-term rental, it's wonderful. So what options do you have in the area that you're buying? And this is a expensive house to maintain and upkeep because it's 119 years old. But if I can get a $2,500 facade grant, which is where I'm at right now, and get one side of it sanded or sanded down and painted, or some sashes on the windows fixed, or they have an energy efficient grant as well that goes up to $10,000 for doing insulation and certain roofs and certain upgrades. So I think exploring all options once you pick where you're going, even before you make your offer, hey, if I'm in this neighborhood, I could get this facade grant, or I could try for this, or this is another program that's offered, is huge. And that's, something I wish I knew starting out, because I was just aimlessly buying and not really without a mission, but now it's more strategic. And I knew when I bought that last year what was available over in that neighborhood. And it's true, I may qualify for none of it, but I'm there and it's an option. So I'm going to try for it and see where I end up.
Before we move off FHA, what is your main pain point with FHA, Tom? I'm curious.
It's exactly what Lauren said, the MIP that doesn't drop off. And then it's kind of deceptive with the interest rate then, since you're having to carry that the whole time. It actually ends up a little bit more ahead with what you're paying because of this staying on there for the life of the loan. So I get the low price point, but typically, like when I talk with clients, I'm like, and we're in very different, we're not in super high cost of living. So usually that 3% to 5%, 3.5% to 5% is not a big jump. It's a few $1,000s, and it just gets you in a more competitive offer. Like last year when I was selling and I had 14 offers on that weekend, I had some FHA, and they weren't, I would rather go with like what Lauren did, a conventional, because I know it's more likely to go through. And that's, something to consider in the hot markets, because you don't want to put yourself in a spot where you're just getting turned away over and over and over again because of the loan that you're trying to use.
Mhm.
Yeah, a good real estate agent should be able to hold your hand and tell you how to navigate that process. You could
Yeah.
put in a conventional loan offer and work out ways to change it later, but yeah,
Right.
that's important. Um, let's talk markets for a second. TJ Edmond on Facebook is asking. He said, "I'm joined late, but I'm in Dallas." TJ is a friend of mine from Atlanta who moved to Dallas recently, an investor and agent himself. Which one of you is investing in Dallas? Who wants to fess up to that?
That would be me, TJ. Just closed on one, and I'm working on another package deal. Off market investor reached out to me. He's ready to cash out. So I am still buying, even with the higher rates, even with the market the way it is, because like the ones that he is trying to sell me right now, they're all cash flow positive. He's tired of getting calls, fixing foundation. I mean, it's all part of Texas. I know foundation issues, and I know I want those parent, like the one that I bought back in February is a pier and beam, and I know I can get under and fix a leak in an hour as opposed to drilling through foundations. So that's part of the market, and I think that there's still plenty of deals around between Dallas and Fort Worth, and they don't make you a ton of money, but they appreciate like crazy. In my experience over the past, I think I bought my first one 2009 here. So that's my thoughts on Dallas.
How about Oak Cliff? Is
Oak
that
Cliff?
a suburb? Yeah.
I will tell you, I just did my taxes yesterday. I was talking to Lauren while I was doing them, and my number one property last year is my Oak Cliff property. And I just bought it at the right time in the right neighborhood, and it's a great. And I did it a little bit wrong. Like everyone in the neighborhood is actually tearing down the houses and throwing up duplexes. I took my house to the studs and fixed everything, but it's a boom for growth. There's money there. There's a lot of people spending money there. So I'm a big Oak Cliff fan, and I have no intentions of selling my property. I had two in Oak Cliff, but one of them stands out.
So if you've noticed differences besides just like price point of Toledo and Dallas being your two main areas, are you looking at different things within the houses, or like you said, pier and beam and the crawl space? Is that not in Ohio and not a concern there? Do you what? Yeah.
Ohio has the basements, and Ohio has the crawl spaces. They don't really have the slab foundation except for the new builds, which are a lot. They're not the $40,000 houses on the new builds up there. So I am dealing with basements and crawl spaces in Ohio, and I'm dealing with slab or pier and beam properties in Texas.
Yeah, when I moved my investments from New York City to Atlanta, it went from worrying about frozen pipes to worrying about termites. And there's no frozen pipes in Atlanta, but issues. But you have termites. We didn't have termites. It was
We
too
get
cold for that
frozen.
in New York.
We get frozen
Yeah.
pipes in Texas. I mean,
Yeah.
it comes down here sometimes.
I guess we do, but it wasn't like something I had to deal with every single winter. Here it's a freak winter, and then we got it.
I have less frozen pipes in Toledo than I do in Dallas, and that's the truth.
Because
people know what they're
prepared for it.
doing,
Yeah.
probably.
And the houses weren't built for frozen pipes, and like I'm doing a shower right now, and they tore it out, and there's nothing between the brick and the shower. They just don't do insulate. They were built very differently in the South 50 years ago, and that this
Not
house was
after-
built in 57.
Not after that winter you guys had a couple years ago.
I know. So anytime I do anything like that, like we went and bought the insulation to do it right now. But yeah, they built them very different 50 years ago in Texas.
We've got another question, Jess Blount from Facebook. What kind of credit should you have before beginning to look at grants for home loans? Should a real estate agent be used? Distressed homes are my target, but what is too distressed on the worth of purchase? A lot of questions there. Lauren, you want to jump on that first?
I haven't done a grant, so I think maybe Tom should answer it.
I think it's 680 is the credit score that you're looking for before you jump over to grants. And the grants aren't based on your credit. It's the property usually. And that's like the one that I'm waiting on for the facade. It's property specific, not so much the me being the owner. Should real estate agents be used, especially for a first property? Sure. But I wouldn't be real estate specific or realtor specific. I'd work with a couple who maybe do foreclosures or get short sales or that type of realtor. Distressed homes are my target, but what is too distressed? I think that if you're trying to do foundation or major systems on a first project, like the I did a duplex in 2020. It took me a year to fix. That would be a horrific first project because I had a electrician take away $3,500 worth of money and not do the work. And I think that is in over your head. So I'm looking at, some things that are manageable over time for a first project. The
Yeah.
ugly kitchens, upgrade some windows, some stuff that can be done as you live in it. And that was always, I bought my townhouse that I bought in 2011 was super ugly, needed a ton of cosmetic, but otherwise it was structurally sound. The roof was okay, maintained by the HOA. That's why it was okay. And that would be a great first, because if you go too deep and you're doing foundation and HVAC and all that, and you don't have a team in place, you can end up underwater super quick by buying the wrong first property. And really that's the thing. Like I have a client who's about to close and I'm like, dude, we need to make money while we're signing paperwork. And while he's signing it and he's buying it for 40,000, we know the value as is 44,000. So as he signs those papers, he's walking into it with $4,000 in equity before he even touches it and even does it. So that's really where I'm at with these properties, but you don't, especially for the first, until you've built a team. And Jess, I know you're in Florida over by Lauren. They get expensive. You have hurricane issues. You have flooding issues. I would look at dated, but not structurally a hot mess.
Right. You don't want your first deal to turn you off to real estate altogether.
No, you're going to learn an education one way or another. I think a couple approaches you also have are maybe hard money loans. They're like conventional loans. They get scared about the distress level, but hard money loans, that's like their bread and butter. You're going to pay more for it, obviously, but they're taking on more risk. But that's why they exist, is to give you loans. You may want to partner with someone who has rehab experience. That's probably good until you have experience yourself. And then another option, which is more of a long-term option, but if you want to create a nonprofit for housing, you can get 503c bonds that basically you're being a nonprofit. You can earn grants that way to rehab and rebuild properties. It's a lot of paperwork. It's a lot of strings attached, but some of these loans are really cheap and they'll give 100% financing. And the money goes back to your nonprofit, and there's ways to navigate that. But I think you have options. But to me, the fastest is partner with someone with experience. If you bring them a good deal, and then talk to a hard money lender, and they can move quick and go from there.
Would you call partnering a form of creative financing on?
I would. Yeah, because I've had partners where I didn't have money, but I had the deal. And my partner had money and didn't want to manage the deal, didn't want to do the flip, didn't want to do the property management. So we bought it 50-50. Sometimes it's 75-25. It depends on the deal and the person and how much work's involved. But yeah, to me, that's very creative to find someone who's willing to pay for everything and in exchange for me doing the work, and we'll share the profits.
And some people don't get that. That was something that I sort of didn't understand early on. Like if I had the money, if I had the money, I wouldn't need anybody else.
Yeah.
But like now I sort of get it as I go along. It's like, it's a lot of work, and some people have money that they want to invest, especially like if you think about inflation being as high as it is, holding on to cash is like the worst thing you can be doing. So yeah, that was something that I struggled with early on. If somebody had $200,000, what would they need me for?
Well, yeah, there's just as many people who don't know what to do with it, right? Or they don't have the time to become a real estate expert. They have 200K because they're always busy at their day job, but they want to diversify. So it's networking. Find those people. They show up on social media and real estate investment meetups, in my DMs. Like they're everywhere. Like
Mine too.
Yeah. Just put it out there, what you're working on, what you have, and just start networking and telling people, what you're looking for. And it's just playing a matchmaker, honestly.
And if you want to do business, follow them. I had someone a couple days, I showed Lauren, I had someone message me and they're like, do you have any tips for investing in Toledo? I'm like, the first tip, if you want something from me, click follow, stop sending me DMs.
The number of times that happens to you is kind of mind boggling. You're welcome,
Absolutely.
Jess. She said thank you.
Yeah, just we got Douglas from Uganda. Happy to be here, joining us live from
Hi,
YouTube.
Douglas.
I've been getting a lot of African questions from Uganda, Nigeria,
Kenya.
Kenya. I I guess I struggle what advice to give them. Do you guys
I
know,
know.
does US advice carry over to
I think they're
Africa?
asking because of the like. I think their inflation. I don't want to say this for the whole continent because I don't know, but the couple of people that I've reached out to me, I think their inflation is so god awful that they have to do something. They can't have no plan. But I don't know. I
Yeah.
don't know.
Or they're pooling their money to buy US real estate. I've seen that happen
Yeah.
as well, just
Yeah.
to park it somewhere safe. Yeah.
I think Tom, aren't you doing some out of country and partnering with somebody in Canada? I know that's not Africa, but aren't you partnering up with people from Canada?
It's definitely not Africa. Yeah, I'm doing a project with someone from Canada, and what's nice about it for him is he doesn't have to do the heavy lifting. I brought the deal. I'm doing the project. He's bringing the money, and I am super conservative. So when I'm buying something, I'm making sure that I'm making money at the closing table. So yes, he's bringing the money, and I'm getting equity in the project, but it's attractive on that aspect as far as he tried this on his own. And when he got that house appraised, he was underwater $50,000. So now we're making sure that he's walking into a project with some equity, even in the changing times.
Yeah, I find that a lot of international investors like Canadians like investing in the United States. TJ's mentioning that he's got Nigerian friends that are doing the same, and New Zealand and Australia, and that's because the United States seems to be one of the few, if not the only country that offers 30-year fixed rate mortgages. Every other country operates an adjustable rate mortgages only, so 3, 5, 7 ARMs, and that's tough to be super successful in real estate if you've got to refinance every couple of years. So that is the biggest draw. Inflation, I think, like Lauren said, but also the fact that we offer 30-year fixed loans, that's mind-boggling to other citizens in different countries.
Did you guys see this one from Henry?
Owner
sorry.
financing internationally is more common than in the US just because of those types of loans, because they don't have banks that will loan on them for 15, 20, 30 years. So owner financing, and a lot of those have been passed down or bought, outright. So people can do that. And that's, I know one investor in Mexico who's doing nothing but selling stuff owner finance. He's buying it, and that is how he generates his income. He picks up a deal or two a year, sells it off with owner financing, and then he has that income every month from selling it that way. So I think non-traditional is a little more common in other countries.
And I wonder if it will be more seller financing specifically now, Tom, like you said, that you're doing with your deal, you're getting a better rate than what is being quoted. I wonder if there will be more of that for that exact reason.
Yeah, I believe so, for sure. And if you can sort of do a subject to take over someone's mortgage who's locked in a 3%, 4% rate. That's
there should be some of that for sure.
Yeah, because that'll add a premium to your price if you can sell it with the mortgage.
In Florida, what's valuable right now is taking over somebody's flood insurance policy. Which sounds silly, but so in Florida, and I want to say it was like 74, 78, something like that. They started having to build up in flood zones, right? You can't build on the ground in a flood zone anymore. And so that used to be like, oh, and then your flood insurance is like $500 instead of like $3,000. And now that's gone away. Even the stilted houses are now expensive. So if you're looking at houses, like it's literally easier to sell your property if you have one of those like $500-$600 flood insurance policies that's assumable.
Oh, that makes sense. Paul Britton on LinkedIn says U.S. wants their people to be successful. That's good. I want to be a country where people support that. I think that's also helps with a lot of the tax breaks that real estate investors get as well.
Yeah, I think Paul's in Canada.
Oh, that's funny. Yeah, Henry wanted to know, and maybe we can end on this sort of note here, unless there's any other questions. If you're listening and following along and have a question, it's go to one of our YouTube or LinkedIn pages, and we'll be happy to answer your question here.
Or my Twitter, because I don't have YouTube. tweet
Yeah,
me?
we're streaming live to Twitter, but we can't see your questions on Twitter. That's the question. That's the problem.
Okay,
So
then
you have to go.
don't go to
Tom's
Twitter.
link. Yeah, go to
Never
Tom's
mind.
LinkedIn or Lauren and I's YouTube, and we can see your questions.
Or Facebook.
Facebook, yeah, Facebook as well. Yeah, that works. Yeah. So Henry, we want to know what's your best real estate advice for newbies.
Who's starting?
It's tough. I mean, I think there's not one overarching, but I'll throw this out there.
I think there's one, but go ahead. I think there's one.
Oh, okay. It's start yesterday is my advice. I mean, I've never met a real estate investor who says, man, I wish I would have started 2 years later. Like that real estate investor doesn't exist. And there wasn't another real estate investor who says, man, I wish I would have read another book or listened to another podcast before I bought my first place. Like no one knows what the hell they're doing on their first property, and you won't even know it. No matter how much prep you do, you can't learn how to swim by watching YouTube videos and reading YouTube videos. Like you're going to swim by jumping in the water, and that goes for real estate investing. So I know I was a complete idiot when I was 21 and bought my first property, and I learned as I went. And so the fact that you're listening and asking for advice, more than I did when I got in real estate.
I agree with that. I mean, starting is huge. What can you do to clean up and get ready if you're not in that spot? I mean, Lauren was selling Monster High dolls while she started. I was folding jeans at the Gap when I started. Alan, who knows what you did, but somehow they gave you a loan. But yes, we all started. Alan, what were you doing when you bought that first one at 21?
Tech support.
Tech support, that's nerd crap. So Lauren and we were way cooler because I was folding jeans and she was selling dolls. We started with these very average jobs. I didn't really graduate because I went to a movie theater. After that stint at the Gap, which I did get Tiffany's glasses for working at the Gap for 5 years, and that's like my big victory there. Plus they also did tuition reimbursement, but the Tiffany's glasses are more exciting. But what can you do to start? And when I was making $850 an hour, which was a lot for the time for 2004. 2004. I was making $850, and that was like, ooh, you're making great money. My light just went out, so now I look dark. But what can you do to start or move in that direction? What can you do to clean up your credit? What can you pay off? And I had a client recently, and she's like, no, these student loans are going to get paid off. And we just started making really small $25 payments on the 3 of them. And sure enough, it moved her score enough that she's now a homeowner. And it cost her $75 for, I think, 3 months of paying on it to move it to where she could buy a home. So what can you do to start? What is going to move the needle enough to get you in that position to start? What can you save? What can you side hustle? What can you do to start instead of just waiting for that right time or delaying it? What can you do? And I folded jeans, Lauren sold dolls, Alan did tech stuff, but we all got in that spot where we were able to start.
And we were young. You guys were both 21. I was 22. Like, that's crazy. Like, think about yourself at 22. I don't know, maybe some of you were 22, but like, man, that's 11 years ago now for me. And I was like, man, I knew nothing. How did I even survive that? I have no idea. But my number one thing is house hack. I mean, right, get started. Once you do get started, house hack, which means buy a property, live in part of it, and rent other parts of it out. Very simply, Tom did that with his very first one. He actually bought a duplex, lived in one unit, rented the other one out. I bought a house and I had a friend from college move into one of the bedrooms. And like, it was like we were living like we were in college, but he was paying me $550 a month and my mortgage payment was $725. So that's the number one thing. If you can I know not everywhere has duplexes, triplexes, quads. You may have to find something that's got a mother-in-law suite, above garage apartment, basement apartment. You can, try to find something or just get roommates. But that's the number one thing you can do when you start. I think like while you're still excited about real estate, while you still have that momentum, is the easiest time to start house hacking. Just take it from me. It's a little bit harder to go back to house hacking once you've just done just living with your partner in a single family home in a really nice golf course community. It's hard to go back, but I've done it 3 times since then. So, but that's the number one thing, because basically you start, if you look at number one budget line item, and Tom, you do financial coaching, so you know this, for everybody's going to be their housing. And you literally can knock that right off the top of your budget if you house hack. And then it's crazy how fast the wheel starts turning and how much you start saving after you knock knock that bill off, kill that bill. Right on.
Yeah, we're all house hackers, and it all changed our lives. So I think that's
Yep.
universal for sure. Yeah. Anything else before we wrap up, guys?
No, we'll be here next week, right? Same time.
Maybe. I'm gonna be in Ohio. I'm gonna be in Ohio, so we'll see if I can jump on and make it work next week. And I have to go look at a house too. So
All right. Well,
I'll try my best.
We'll do that house tour with you. Lauren and I will
Oh,
be
that
here.
would be fun. That would be fun. Yes. Look at
Okay.
this, guys. Oh yeah, let's do a live house tour.
That would be
Okay.
fun. Okay. Well, if you're tuning in, we want to do this regularly Thursdays at noon Eastern. So come
Right in the
prepared
middle
with
of my
questions.
gym. Thanks, Alan, for that. The gym
you-
routine
you're
got
looking
cut
too
My
short.
short.
fault. It's my fault because I have a 9 to 5 and this is my lunch break. You can blame me.
Lauren
Yeah.
ruins everything.
All right, guys. Thanks for tuning in. Thanks for all the questions. And you can watch this later live as well. And thanks for tuning in, guys.